Hello, welcome to Bogart Wealth's webinar series. My name is Nell Cordick, and I'm a Senior Wealth Advisor with Bogart Wealth. Today's topic is what if retirement comes earlier than expected? For those of you who might be new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. A little background on us: we have over $2.8 billion assets under management and are working with about 1,300 households. We are a registered investment advisor, which means we are an independent fiduciary advisor working in your best interest. We custody our assets at Charles Schwab for your protection, and we are a fee-only wealth management firm. Bogart Wealth has financial advisors in both McLean and Houston, and we work with clients in numerous states around the country. We have a full operations and financial planning team in our Virginia and Texas offices. In addition, we have our investments in-house and also work with a local CPA firm in Texas to help our clients with their tax preparation needs. We have 3 offices with our headquarters in McLean, Virginia, and 2 locations in Houston, one in Gessner and one in the Woodlands. At Bogart Wealth, we believe in educating our clients. Periodically, we will do a series of webinars and in-person events on a variety of topics. We welcome you to visit our website to gain additional information on these and other topics. What is our process? So basically, for those of you who work with us, you know that planning is the heart of what we do. Most people think that planning for retirement is just about investment management, but everyone's situation is different, and it is very important for us to focus on your goals and manage the issues that are important to you. Part of the retirement process revolves around cash flow withdrawals and withdrawal strategies, tax planning and tax optimization, investment management and tailored portfolios, estate planning and trust review, and then it's very important that we continually review this process, always coming back to doing the full analysis of what your situation looks like today and projecting what will it look like in the future. So today, I will be talking about, first, the importance of planning for retirement, second, planning for income in retirement, and third, I will briefly touch on the retirement process. We do have an additional webinar that goes into greater detail on this part of the topic, and we would encourage you to attend. So first, why is wealth planning so important? If you plan ahead so you have ample time to understand the effects of choices and to make the choice that is most optimal to you, it's very important to think about what are the risk factors, what are your choices as far as funding your retirement, how do you position a predictable income, how do you create a sustainable withdrawal rate, an appropriate withdrawal strategy so that you will not outlive your money, and how do you monitor and adjust to stay on track is very, very important. But as you're creating your plan for the future, there are a lot of external factors that you should consider in making your choices. So first of all, your family. What is the impact for your family for various choices that you may choose? Secondly, health. Retirement is a big decision, and you must plan on future health issues that could arise is an important factor in your plan. It is important to know yourself and understand how dramatic the retirement situation can be. Home. Where do you want to live in your retirement? Do you want to stay in your same home? Do you want a new house? Do you want to be in a larger house, or do you want to downsize? All of those are important decisions. In addition, look at what your lifestyle is. What do you want retirement to look like? It's very important to plan for your hobbies. You will go from having 2 days off a week to having 7 days off a week. So it's important to think about how you would spend that time. Work. Some people decide to have a second career or part-time work. Think about what is right for you. Legacy. Do you want to leave a legacy for your heirs? And do you have a certain amount in mind? Because that can certainly affect your own spending habits by creating what you want to create as a legacy. And then very important is to really understand your mind and spirit. Do not discount this. Retirement is a big decision and it is a big transition. And it is very important to also understand that it's highly emotional. So that is very understandable and very acceptable. Couple of things that when you're thinking about what are your greatest fears in retirement, this just represents that there are a number of things that, people that are not retired yet are mostly worried about, am I saving enough and when am I making the right investments to be ready for retirement? What will Social Security look like at some point in the future? Understanding that maybe my health I may need long-term care in some ways. So a lot of those things are more important to people that are pre-retirement, but they are important to people that are retirees as well. However, going forward, sometimes the importances will change. In terms of running out of money is one of the main concerns of retirees because you are now paying yourself instead of relying on pay from an employer, and that's a very important factor. But these are all some very interesting considerations to take into account. Some of the biggest fears also really are around 4 key topics. First is longevity. We are all living longer today, and therefore no one wants to outlive their money. So it's very important that we are planning for age 90, possibly age 95, in some cases maybe age 100 for our life expectancy. Secondly is inflation. Basically, we want to make sure that we are properly planning for inflation in any future adjustments or any future plans. For instance, a 3% inflation rate can reduce the purchasing power of $50,000 down to $23,000 and change within 25 years. Third is market performance, definitely a factor. There will be ups and downs in the stock market. It's very important to understand that as you're creating the proper sources of income and understanding where you can project your withdrawals to support your lifestyle. Fourth is healthcare. Healthcare costs are rising faster than average inflation. And in the event that you did need a long-term care, a recent study estimates that a couple age 65 will spend $230,000 in retirement to cover basic health care, and that's not including nursing home expenses in the event of a major long-term care need. So it's very important that you are creating an individual plan for your own retirement and how you want to live it. You're unique and your plan is unique. So what is retirement income planning? Basically, we are working with you and we're looking at historical averages to help forecast future needs. There's no such thing as an average retirement. And we also really look at a 4-step approach. We want to customize your future spending according to your goals. We want to include assured income for essential expenses. And we want to offer flexibility in your plan to adapt to times when life will be different. We don't know every single situation that's going to happen in the future, so we always want to build a plan that does have flexibility for you. Creating income from your portfolio is fundamentally different than building wealth. And quite honestly, this is one of the hardest transition steps for retirees, to begin spending what they have spent so many years diligently saving to, in terms, turn it on as an income source. We actually believe in creating a very methodical process designed for your life and your unique financial needs. When we are creating very similar, as far as we create your plan, we want to first analyze where you are today and where you are projected to be in the future. We want to always be reviewing your investment strategies, reviewing your withdrawal strategies, and then continually monitoring with a continuous review. And this is a continuous circle that will happen the rest of your life. So how do we do this? Number one is analyzing your retirement needs. It's very important to understand what makes your retirement unique. We need to work with you on prioritizing lifestyle goals and set realistic expectations on financially achieving them. How much income do you need each year? And that may change in different times of your life. When you first retire, we call those the go-go years. You're very active, you're doing things, you're traveling more, you're doing more hobbies, but you're experiencing life. Then we get into a period where we call slow go, where you kind of are in a maintainable situation where you're still going, but you might not be increasing every year. And then we get into the later stages of life, which we call the no-go, and you really do start reducing your activities and possibly some of your spending. Realistically, it's important to estimate your expenses, and we categorize them into 3 areas. First is essential expenses, which are the absolute. Those are your needs. Second is discretionary expenses, and these are the things that you would want to have. And the third is always having a place for unexpected expenses and or wealth transfer goals. So when we are working with understanding of how to analyze your retirement needs, we also want to take into account what are the inflation assumptions. We actually build into our plans an assumption for higher inflation for healthcare expenses than for normal expenses. We also can build in extra cost for long-term care expenses at different phases of your life. We want to make sure we're identifying all of your income sources, whether it be Social Security, any type of employer pension, your own savings, investments, rental income, business income, any type of inheritance, a sale of a home, etc. And then we want to run the numbers to determine if your plan works on these key assumptions. And that will give you confidence in moving forward with the plan. Now, you will have lots of choices. When it comes to spending, you have basically, as we talked about, first of all, those essential spending. You've got to cover your food, your housing, your health care, your insurance, etc. The discretionary expenses are entertainment, travel, gifts, memberships, those type of things. And then we always also want to keep aside enough funds that would be considered your emergency or unexpected expenses. And then we do want to take into consideration which of those income sources will automatically receive a cost of living increase. So what are your sources for retirement? First of all, Social Security basically replaces 90% to less than 1% of the population. For U.S. median income, it basically replaces 40% of their income, and at maximum covered earnings, it is basically a 27% salary replacement. So you will need other sources of income besides Social Security. Secondly is pension income. So only about 11% of the population is covered by pensions as of 2021. And typically a fixed annuity, depending on the age, service, and Social Security, may replace about 50% of salary at age 60. So then the rest of your income is going to be provided to you via your 401ks, IRAs, etc. And that is the number that must fill in the gap. So we do like to do analysis way ahead of time to make sure that those savings will generate the proper amount of income. This just is a slide that depicts the Social Security salary replacement based upon increased earnings. What is the percentage of salary replacement as of 2024? And then step 2 is, what is your investment strategy? So basically, and I won't spend a ton of time on this, but just to give you an idea, there are lots of investment vehicles that you can work with from an investment strategy. And really just to give you a highlight, there are annuities, there are bond ladders, there's income-oriented investments, there's a fixed asset allocation, better known as modern portfolio theory, and there's dynamic asset allocation as well. I would say all of these strategies have benefits or pros and cons, but everything is very unique to what is best in your best interest and for your particular situation. A comprehensive strategy might include several of these particular strategy elements. That is not uncommon. So when you're thinking of the particular investment strategy, there are also different levels of products within each one. And so based upon whether it be areas that you can choose from that are totally based upon market risk and return, that are rebalancing in terms of a fixed percentage of ownership of different securities, there might be dividend stock, there might be preferred stocks, there may be MLPs, there may be individual bonds, there may be annuities that are fixed or indexed, but I really want to convey that there is a huge variety of products that are out there in the investment arena, and the critical thing is that we choose with you what's going to be in your best interest and meeting your goals. So I want to emphasize also, emotions can absolutely destroy your plan. Basically, fear and or greed can lead to buying high and selling low. Again, another reason to work with a professional, because that will help you to not make those wrong decisions at the wrong time. Our process is designed to help prevent you from making the wrong decisions based on emotions. We build a portfolio that is consistent with your risk tolerance. We will cover essential expenses with lower volatile investments, and we will employ strategies when there are volatile markets. And that's, a critical component is there will be volatility if you're invested in the market, but we want to make sure that we are managing the appropriate risk level with you. Again, going into some just high-level overview, annuities can be, things that have a fixed interest rate. They can have an indexed component, or they can have a variable component. When you're looking at bond ladders, the thought process behind a bond ladder is that you would invest in bonds that have varying maturity dates so that as one matures, it could create cash flow. It could be reinvested at a hopefully higher interest rate, but that it's constantly going to be reinvested at whatever the current prevailing market rates are at the time. So you're not putting all bonds into only one interest rate. When we talk about yields and cash flow, that's also where this is really looking at fixed income strategies is you can do bond ladders. There are lots of different types of bonds. There's preferred stocks, there's royalty stocks, there's dividend stocks, there's treasuries, but lots of different products that can create income. And again, we want to help you make it unique to your situation. And when we're looking at income-oriented, you basically are looking at the effects of market values and dividend paid. Now, they don't always work completely in correlation, but dividend income does tend to be more stable recently than in the past. But dividends do not always increase every year, but over time, they have tended to outpace inflation. Looking at asset allocation basics, this is basically saying based upon your risk tolerance, then this is a portfolio percentages of how much you should be invested in bonds versus equities. And it's basically giving you an idea of where along that spectrum is the most efficient place. And that's basically how we manage portfolios here at Bogart Wealth, is we are working towards that's one of the ways that we manage assets, is working towards various levels of risk and maintaining the asset allocation to adhere to those particular risk levels. Why is dynamic asset allocation also something to consider? Is that basically this is also taking into account structure, risk, and opportunities in the overall marketplace. And dynamic allocation is a process. It is not a timing method. It is based on actual trends. Prices reflect the market reaction to geopolitical concerns, economic upturns and downturns, industry or sector opportunities, and interest rate changes. And this just basically gives you an illustration of a periodic table of all the various investment classes and what their performance has been in any given year. It gives you an indication that there's not really a specific trend, which is the importance of being diversified within your portfolio. And the third process is developing a withdrawal strategy. So first, you want to think about there are different levels of strategies that you can choose from, and I'll try to go through each one of them. The first one that we want to consider is looking at income only. So when we look at the income only strategy, that means we're only taking the investments from the interest and the dividends that the portfolio is producing. This may or may not be enough to sustain what your total income need is. The second withdrawal strategy is using the bucket approach. And this is where we are basically identifying what is the income need going to be for the next 5 years. We keep that amount in very safe, low volatile investments such as cash, CDs, very high grade bonds. Then we look at what is the amount that you will need for the following 6 to 12 years. And that's also kept in fairly conservative accounts, maybe bonds, could be some low volatile stocks. And then the third bucket would be your long-term bucket. This would be more of your growth bucket. And as we have additional income that's generated from the growth bucket or the middle bucket, we'll be moving that towards the safe bucket to create constant flows of income. The third strategy also in terms of understanding how long will your portfolio last, it really is a combination of several things. It's a combination of what the average return will be and what the inflation factor will be. So withdrawal amounts will increase annually based upon inflation. And this first slide is illustrative only, that basically if we're saying you're taking, in this particular case, we are assuming a 2% inflation and we're assuming a 5% investment return. And with that case, at a 3% withdrawal rate, your portfolio would basically never reduce itself at all. If you increased your withdrawal rate to 4%, It's basically saying that within 45 years, your portfolio would be depleted. If you increased your withdrawal rate to 5%, it would be depleted within 30 years. Increasing it to 6% would be about 25 years, and increasing it to 8% would be about 15 years. Now, it doesn't mean, in some cases, there are cases where you may have certain years where you have a higher withdrawal rate, but we're looking at the overall long-term withdrawal factors. Now, this particular slide is showing an investment return of 8%, but an inflation factor of 5%. Very similar, but you can see it does have a little bit more variation to it accordingly. Now, when we look at also when you're making withdrawal source choices, it's very important to take into consideration taxes. And we do spend a lot of time with our clients on tax planning and tax strategies. So first of all, you think about your Social Security is only 85% of the income of the benefit is taxed as ordinary income. Pensions and annuity income is taxed as ordinary income. Interest income is taxed as ordinary. IRA and 401k distributions are taxed as ordinary. Dividend income in a non-IRA account is taxed as capital gains. Long-term capital gains are taxed as long-term capital gains. And then Roth IRAs are not subject to any taxation. And basically, we would look at the liquidation order to determine what is the most optimal in any given year from a taxation point of view as we're creating your withdrawal strategy. And it may change from year to year. This particular slide will demonstrate the differences currently in the ordinary income tax brackets versus the capital gains tax rates. So you can see that ordinary income graduates much quicker than the capital gains rates do. So we also have choices in how do you manage the distributions. So you typically will look at what are your choices and you think of what are my lowest tax consequences. It would be non-qualified, then qualified, then Roth. Roth is growing tax-free. So we typically think of keeping your Roth as the last thing that you would actually distribute from your portfolio. And this is a good rule of thumb, but it's not always optimum. So again, we will look at your specific situation and what are the best strategies for you. We also always need to take into account to manage your required minimum distributions. At age 73 or age 75, if you were born in 1960 or after, you will have to take required minimum distributions from your IRA accounts every year. The percentage will increase with age, and you are able to withdraw more if you want to. But if you would withdraw less than the RMD is required, then you would face a substantial tax penalty. So it's also very important that throughout your early retirement years especially, we are taking into consideration the consequences of required minimum distributions and looking to see, is it optimal or would you need to consider converting part of your IRA to a Roth IRA? This tab just simply shows what the percentages that you would have to withdraw for required minimum distributions based upon your age. And then step 4 is cash flow never stops. It is probably one of the key things that causes stress in retirement. So it's very important that it is constantly discussed, constantly reviewed, and also looking to the future to determine other cash flow needs that may be on the horizon. Now, how do you create the retirement paycheck? And that's something that I think that we absolutely are very good at here at Bogart Wealth. We work with, what is the amount that we're needing to retire? We build a foundation for the essential expenses. We do have an amount for discretionary that we are utilizing. And then where do we get it from is basically utilizing a diversified portfolio strategy is very critical. And we make sure that we have the essential expenses covered. And then we're looking at what are the discretionary and what effect does that have on your successful retirement picture long term. It is complicated. You need a plan, and we would love to be your partner to help you with that plan. Now, when you are looking at, as you are staying on course, the component of understanding and reviewing is so critically important. We want to make sure that your spending strategies are not putting you at risk. Now, that doesn't mean that early on you may be spending more, but we want to be looking at that very critically. And even in years where the market might return a negative return, then it's critical to look at the discretionary expenses very carefully. It's also important to continue to monitor what are your withdrawal strategies. In some years, we may take it from one area of your portfolio, and other years, based upon market conditions or based upon tax situations, we may take it from another. Now, regarding ExxonMobil, we also take into account when you retire, what is the best time for you to make your BCD? Basically, which discount rate first applies to you. The general rule is that the rate in effect on the BCD is always the first of the month. And so, for example, to get the second quarter discount rate, your BCD must be June 1st at the latest. If you are grandfathered and you chose the first available BCD, it would go into effect on your first day of retirement, which is the first calendar day after your last day of payroll. Grandfathered means that you were born before 1958 and hired before 1998, which it means that today you must be at least 66 with at least 26 years of continuous service. Most people will fall into the non-grandfathered area, and basically there we're using 3 segmented rates based upon segment 1, segment 2, and segment 3, based upon different years of your retirement. In terms of the segment slide shows just the history of what those rates have looked like. And then this particular slide, just an example of over the last 2 months, in terms of how segment rates have actually been used over the last 2 cycles that you may find interesting there. We also we will do projections on a regular basis on what we see the discount rates being at some point in the future. And we also work with you in advance of your retirement date on those rates. So then you have to ask yourself, should I actually consider delaying my pension? And it's very important to then look at several different options. Number one, do I need that lump sum money or that pension money right away? Am I retiring before age 60? And do I expect interest rates to rise or fall in the future? May affect your decision. Here at Bogart, we build an extensive retirement roadmap for you that kind of lays out in specific time zones exactly actions that you will need to be taking during your retirement. And we work with you specifically on that. Strategies, though, that you need to consider now is, first of all, have a plan and create a budget. That is one thing that I probably see retirees have the biggest struggle on is what are they planning to spend in retirement? And what does that look like? And so understand what your cash flow is today, and that will help you understand what it needs to look like after retirement. Also start to anticipate what are future expenditures? What are home improvements that you may have? What are travel expenses that you're thinking of? What are any type of healthcare needs that you're thinking of doing? But then understand also what your long-term risk profile is, because that will help you to consider both your short and your long-term goals. We also think that it's important, some qualities that you might consider when you are selecting an advisor is the Certified Financial Planner designation is very important. An advisor that knows your retirement plan, that knows IRS retirement rules, and has navigated multiple business cycles, and has experience in managing portfolios in multiple business cycles. We think that it's important for an advisor to be open to discussing various strategies with you, and also to provide financial planning based upon your needs and risk tolerances. In addition, providing regular portfolio performance reporting, and most importantly, is making sure that they are listening to you and speaking to you in a way that is fully understandable. We welcome the opportunity to meet with each of you one-on-one in a financial strategy session. There is no cost nor obligation for us to go through the planning process with you, and we welcome that opportunity to do so. We are located, as I said, in Northern Virginia and in Texas, but we work with clients all over the United States, and we welcome that opportunity to work directly with you and give you information that will help you going through this process or this time of your life. Thank you for joining us today, and we look forward to meeting you in the future.